Chris Powers and I recently got together for a live webinar. You can figure out when and where these are happening by getting on my email newsletter at sweatystartup.com. But we discuss current events. We discuss the highlights of our acquisition process. We discuss the market for GP fees and raising money. We discuss a lot of really cool things. This is going to be a two-part episode. This is part one. Next week, we will release part two. Enjoy. Chris and I are going to start doing these discussions. Thanks for joining, everybody. For those of you who don't know, Chris is the host of the Fort podcast. He lives in Dallas, Fort Worth. He does Class B industrial, is building a massive real estate private equity company. They acquired 290 million plus last year of industrial. Chris, you and I have been good friends for a while. These episodes have been a hit. We're just going to riff on some stuff. I mean, a little bit of current events here, a little bit of lessons. We're just going to try to have a good, lively discussion. So, Chris, what's up with you, man?
A whole lot. Just sunny day in Fort Worth, Texas. It's actually 70 degrees.
So you say not a whole lot, but I want to start with this phone call 4 nights ago that you called me up. I was tired. I was about to go to bed. And I think you were on your way home from work, about to go to dinner. And you basically said that the Fort is exploding. I mean, or Fort Capital is exploding. You guys are expanding to some new markets. We don't need to expand on where or what exact deals you're working on, but you all have a lot under contract. Run me through a little bit of what's going on.
Yeah. One, I think it's just cool that we chat pretty often. I think everybody needs like an accountability friend or friends. You kind of made the note that we had this call, and then I think you even tweeted that you hung up and went and worked really hard and sent a bunch of LOIs, but
I did.
It's an iron sharpening iron thing. I think that was really cool. We've been super busy. We are actively trying to break into Florida, Orlando and Tampa to be specific. And we are hunting around Miami right now. Can't disclose too much right now, but you will probably hear of us popping into Florida. I like Florida for a lot of the same reasons I like Texas. Great business state, great weather, great people, very pro-business. One of the interesting things about Florida is it's a lot more landlocked. So there's a lot more, undevelopable land due to kind of, how the state lays out and water floodplain and things like that. So it's a lot more limited and supply constricted than Texas is, which is interesting. And then you have the population and job story, which I don't think is going to slow down. And then, of course, industrial has its own tailwinds. We just broke into Memphis, and we're really excited about Memphis. Memphis has that Ford just announced one of I can't remember the exact, but $3 to $5 billion plant for their electric trucks and electric vehicles going into Memphis. Tennessee is a great state, and carries not the same fundamentals as Texas and Florida by way of population growth, but we're buying stuff at a basis that we were buying in Texas 4 or 5 years ago. So we like the value play there. Houston, we have 7 deals under contract in Houston right now. We've closed 2 of them last week. We have 5 more that will close on in the next 60 days. San Antonio, DFW has been really tight lately. I don't think we have 1 deal under contract in DFW right now. We have a lot we're looking at. So yeah, we're really focused on Florida. We're really focused on obviously Texas. And I think, between that, I think Phoenix and Atlanta are interesting, but there's only so many places you can spend your time. And if we're going to go outside of Texas right now, Florida seems like the most obvious bet for us that we understand.
So you're going to buy a couple million square feet there. I mean, last year was a year where you acquired a lot, also had some dispositions. You've mentioned this year that you might not sell much this year, but you're going to buy aggressively. You think you're going to do more than last year? I mean, can you do more than last year?
Yeah, I think we'll acquire 2 to 2.5 million square feet this quarter.
Oh my God. This quarter? I thought you were going to say this year.
Well, maybe some of it will close like first part of next quarter, but look, we really believe in the industrial story. People ask me all the time, like, what do you think about the market? I think about it a little bit, but I think the big lesson I've learned over time is like what's going on in industrial where we're doing is different than office in New York City, or if I'm really hyper focused on what we're doing, I still feel like we have a lot of room to run. I could look like an idiot when the dust settles, but there's just a lot of things, and I've talked about it over and over, and we don't have to use this time to go through why I like industrial, but I'm still really committed to it. I still think it's really early, and we're in kind of a perfect storm situation. So anyway,
Yeah, our self-storage is getting really hot. I mean, we look at the market now and we're like, should we sell some stuff? Because we feel like we're paying up more than we've ever paid. Cap rates are compressing. But frankly, I mean, rents are growing so quickly. We're buying self-storage facilities where they were charging $60 when we bought the building. We raised the rents to $99 after acquisition. Not only did nobody move out, but we're renting units now in the same market at $129 for a 10 by 10. So even if interest rates go up, even if the market settles from a cap rate compression or a cap rate perspective on the market, I mean, I think over the next 5 or 10 years, our best bet is just to keep buying storage and operating it really well. I mean, that's the only thing I can think is the wise thing to do here.
I agree. And I think, and we'll talk about it in a little bit, but the amount of capital coming into real estate right now, and with rents growing, even if we don't buy a deal, I always tell our team, like, I'm really excited that so-and-so bought that deal next door, because they have no choice but to try and push rents and move the market. And with this much capital trying to get into self-storage, industrial, multifamily, a lot of these things, look, you don't have to own every deal to benefit from deals getting done. And I think the other part is you got to look at the motivation of a lot of these sellers, especially the ones you're buying from, but a lot of the times the ones we're buying from, they have optimized the properties for cash flow. They've optimized them for not rocking the boat. They've optimized them for, high occupancy, because they don't have the resources to just deal with lots of vacancy and lots of marketing when needed and talking to lots of brokers. And so there's still, to this day, is one of the highest amount of upside in just operating better. And, I'm not going to go through some of the numbers that we privately discussed on that phone call, but anybody to say like the market's really hot right now and that there's no deals is just absolutely not true. There's stuff we bought 6 months ago that is worth significantly more than we bought today. Some of that's the market pushing us forward, but a lot of that is operating it much differently and bringing a new strategy, to an owner that prior to us might have owned it for 10, 15, 20 years and just didn't want to rock the boat. And, again, I think we're playing an operator's game now at this point of the market, where if you're going to place bets, you need to be able to operate and optimize for operating.
I just dropped a tweet in the chat that drew some controversy. I said, I've been in real estate long enough to learn that the real badasses build a model to buy assets at market price. The fakers complain about the market price and never afford to buy much at all. And those are the same people who, in relation to your tweet, Chris, the market is what somebody's willing to pay. The market is not what somebody else thinks somebody else is willing to pay. But anyway, I said, the fakers complain about the market price and never afford to buy much at all. This market is insane, is something that a faker says. We are going to buy 2 million square feet of whatever in this quarter, is what a badass says. So, I mean, yeah, I think dollar cost averaging into real estate over the next 10 years. Okay, we might buy some stuff that's worth less for a little while. We focus on cash flow. If we operate really, really well, and we believe in the 10-year thesis, and we're protecting our downside, we're buyers, right? I mean, come on, let's do some business.
Yeah, I think, one of the differences between now and 08 is really people aren't able to take on the leverage that they were taking on before. I mean, you were hearing stories of people that had never built anything ever, developing condos with like 100% financing, non-recourse, and just some madness. And, we're at 65, maybe 70% on everything we buy. That's not to say that that's even enough in a severe downturn. But if you talk to most bankers and most borrowers this time around, some of the restrictions the government put in place are a lot healthier. And, the leverage is not where it was kind of 08, 09. I would say I've been pretty vocal about this, but I think the NIMBYism world and the ability to get stuff built and add new supply has become a lot more challenged with the rise of social media. Everybody listening here probably is in somebody is in a next door kind of chat group online. If you've ever watched a next door chat group go to town on a developer when a development's even announced, It's becoming a lot harder. Today's front page of the Dallas Morning News was a home builder that's been building in DFW for 30 years, screaming at city council, saying like it's virtually impossible to get permits today. And he's been here for 30 years. And so that carries into self-storage. It carries into industrial. It carries into a lot of these things. The pace at which the demand is rising for the asset and the pace at which supply can be delivered is continuing to separate itself. That really wasn't the case in 07, 08, especially if you look at like an easy metric, which was home building. We were like oversupplied with homes in 07, 08, and fast forward 13 years, we're crazy behind. So yeah, I wouldn't say that's a license to go buy and go crazy. But it is a license to understand your asset class really well and know when you see opportunity. And like you said, sure, do I wish I was buying stuff at 2014, 15, 16 prices? Yes. But if you're in the business that we're in, you can either be in the game of wait for those 1 or 2 years every decade where it's just buy everything cheap, and that's certainly a business to build. But if you're going to deploy capital over time and your investors understand what you're doing, you're not playing the game of when can we catch the bottom? It's hard to build a big company or a sustainable long-term company if all you're trying to do is catch the bottom. There's certainly people that can do it, but it's not like, you have to be in a totally different league. You're playing a totally different game if that's your business model.
Yeah, I think the cheat code in real estate is to be paid to wait. I mean, if you have time, if you buy an asset and you know that you don't have to do anything for 10 years, meaning you have access to debt, not necessarily in a small window. You don't need to flip it. You don't need to remodel it. You don't need to sell it. You don't need to do all these things that require a timestamp. You can just get paid to wait, have cash flow, hold on to an asset for a long time. And yeah, I don't know where I've sent a recent investor letter. I don't know where self-storage prices will be 18 months from now. I don't know where interest rates will be. I'm almost positive they'll be higher. Will they be 6%? Will they be 7%? Will they be 5%? I don't know, but they'll be higher. What I do know is that 10 years from now, sometime between now and 10 years from now, the market will be very, very good. And that's when we might, we'll have options, we'll have opportunity. So yeah, that's, minimize the downside and wait.
The other biggest part for being in the game is if you've been sitting out of the game for a long time and all of a sudden the opportunity comes along, you haven't been building rapport with brokers for years and people in the market for years. And so
investors.
Correct. There's kind of, now look, the big boys that have billions of dollars, we're not talking about that. But if you haven't done a deal for 5 or 6 years because you've been waiting for the economy to crack, there's new brokers in the market. There's new lenders in the market. There's new equity in the market. The people that'll be ready the most, assuming they haven't made some catastrophic failures when the market goes down, they're already in the game. I think a big part of building a successful career is being in the game. And so that's all to be say. Like, of course, we're very aware of where we are. We're aware of how things feel. We're aware of where we were buying 5 years ago and where we're buying now. But if you really pay attention to the fundamentals, supply and demand, there's still a good reason to believe that those are still strong. Now, can prices go down? Sure. But if your time horizon, like you said, is a decade, there's still plenty of opportunity out there, in my opinion.
Okay. So I'll give you kind of a personal situation here. I met with somebody who's a mutual friend of ours, came to Athens. We sat down and had some lunch. His advice to me was to sell everything, to sell my entire portfolio. And I put pen to paper. I didn't dismiss it. I mean, obviously I don't want to sell. He said,
why?
Get bunker money. He said, his argument was simple. Nick, get bunker money for you and your partner, sell what you've built. Your GP, your real estate private equity company is valuable. Your management company is valuable. All your assets are valuable. Your acquisition pipeline is valuable. Sell it all, or sell part of your promote, sell out part of your company, find a partner who wants to buy part of it, take all the risk off the table for you, put $20 million in the bank and do what you love, which is obviously to tweet, make podcasts and talk to people. I don't know. I mean, that I put pen to paper, and I'll give you a real example of something that I'm dealing with right here. So we have a portfolio in upstate New York, and our cost basis is about $21 million. It's 12 properties. Our cost basis is $21 million. We've had a lot of success driving revenue. We're operating at lean. We have another property in one of these towns that went on the market at $225 a square foot. I reached out to the broker. I'm not going to be able to touch this deal in my own market because it's going to go so high. It's going to go at a 4.5 cap for, we're talking about a $6 to $7 million deal. Running some numbers on my portfolio that we acquired up there, just all in the last 3 years, I could sell this thing for 50 million bucks. My basis is 21. My promote's 50%. My partner and I split that half and half. Right there. Again, this is that's a life-changing generational wealth building opportunity. It's kind of silly for me not to potentially take one of those, right? What are your thoughts?
Yeah, I mean, we've sold 3 portfolios in the last year and a half. If I sat here today, could I have made more on the first one we sold today? Yes, sure. Some people will say, why'd you sell? Were you trying to time the market? I just said, no, it's your opportunity cost. Like if you have places to put money when you sell, you have chance to change your life and live your life a little more comfortably. A lot of people early in their career have to sell and build a track record. And if the goal is to optimize for sleeping a little bit better every night, returning capital to investors, you have 50 more years of a career. I don't see why selling a few assets early on in your career and changing your life is such a bad thing. There's a lot of people like, but you would have to pay the government. There's a lot worse things in life than paying the government on making life-changing money. I just like, that is my unequivocal answer to that. I've been fortunate to be in some of those situations before, and I will tell you, I don't regret any of them. And what I will say though, is as you build wealth, that conversation of should you sell or not, that gets easier to have because you're not kind of setting the foundation for your life, your kids' life, your grandkids' life. So I fall in the camp of sell. And look, Nick, you're buying like 30 deals a year. It's not like you can't replace this quick. You can't 1031 the money. There's lots of opportunities you have. For some people, they don't sell because they've owned it 30 years. It's fully depreciated. They don't have any deal flow. If they sell, they have taxes. There's all these reasons. But look, I tend to model myself after I'm growing our business like a Blackstone, a Starwood, some of these large, platforms, they sell like crazy. They buy on market a lot. They sell like crazy. They buy it, fix it, flip it, and they're very wealthy and they're very happy and they've made a lot of people a lot of money. And it's just a different way to look at it. You can steward assets forever. That's not bad, but I'm not telling you what to do or what not to do. I just say you're very fortunate. And if the world did turn in a year, maybe ask yourself that question. Will I regret not having taken those chips off the table if the world has turned a year from now? And if the answer is no, then don't sell.
That's what my friend said. And he said, look, there's curveballs that I've seen very, very wealthy people over the years. Well, paper wealth, right? Not cash wealth, just pay a lot of equity in deals similar to my situation that had a curveball come, political change, a pandemic, something totally out of their control, that 1 in 1,000 event that maybe there's 20 events that could happen that are 1 in 1,000, that would suck if that happened, right? The odds are, of course, you'll be fine right off into the summer. This summer is going to be phenomenal for self-storage. We think we're going to add a ton of value to this very portfolio this summer, but man, wouldn't it suck if it all went away? And I didn't really have an answer. I'm like, yeah, you're right. It would suck.
I would think long and hard about it.
Yeah.
In
so
the
grand,
in the grand scheme of things, I think you're setting your family up a lot better than you are by, I don't know. You have an opportunity.
Trying to optimize it for another year to make a couple extra $1 million, right?
Yep. And I will say this, I think this is the most underrated part. And I can speak from experience here. Building a track record is huge. I used to really wrestle with this, saying, why do I have to sell my asset to prove to someone I did well on it? Can't we just agree that at this point in time, this is what I could have sold for, and I can go and tell the world that? And while in theory that sounds good, the truth is people don't really give a shit. They want to see that it sold and went full cycle. But where I wanted to go with that is, the intangibles of having a great track record and selling, and the market that you're in knowing about it, and the investors that you're in knowing about it, and going to Thanksgiving and telling everybody about Bolt Storage, and the bankers being willing to lend to you even more now, and the lawyers want to work more, and the brokers know you've proved yourself. Like, the value of selling is actually much more than the dollars you take home in that one transaction. It might create $50 million more of opportunities. And there could be people that challenge me on that and say, that's just not true. And I would just say, from my experience, and this was what got me over the hurdle when I decided to start selling, was people telling me, you should see what it'll do to your brand, reputation, and track record to go ahead and sell. And so what I would tell you is, no matter how much money you're going to make, I would challenge you to think deeply that you might be making twice as much in value that will show up in the preceding months and years to come. So that's what I tell everybody. There's a lot more to selling than just the dollars that come out of the properties.
Yeah. Yeah. Getting more co-invest. I could do a significantly higher co-invest on all my future deals, put that equity to work, start adding value on new properties. Yeah. Blake Boyd says in the comments, he says, pigs get fat, hogs get slaughtered, take the money, pay your taxes, and never have to set an alarm clock again, ever.
I love it.
That's what he said.
I don't know.
I don't have an alarm clock right now, except to get my kids to school, but
I will tell you this. There's a lot of people I've met that could have sold in 07. I'm not saying that they got wiped out or anything, but it's easy when things are great to not want to sell. And I remember how I felt even in March of 2020. We were in the very pits of selling our first portfolio, had just done call for offers in February. World was riding high. March 2020 hit. And I remember I was sick to my stomach going, I'm one of those guys that missed the boat. I missed it. And I was sick to my stomach. Fortunately, the world has turned out differently over the last 2 years. But I'll never forget how much, I wouldn't say regret, but how sick to my stomach I was that we literally missed a window by about 60 days in a 100-year lifetime. So
what do you think?
Anyway.
What do you think when I would say that the property is more valuable to me than it is to everybody else because the other operators haven't caught up? Would you recommend an institutional partner to stay on, to manage these assets, to keep the promote, to recap in a different, bigger way, to recapitalize the assets in a different way? Or would you recommend literally putting it on the market and sending it off to somebody other than Bolt Storage?
If you're going to recap it, I think that's a very noble opportunity. I would just say, for somebody that's just now getting to that first cycle of deals, and you're going to see 1,000 deals over the next 5 years, I promise you, any properties you sell today, besides the outcome, you will have forgotten about 6 months after you sold them. You'll be so heads deep in what you're doing that I wouldn't get so fixated on this tiny point in your career and look at the really big picture. What could a big sale do for Bolt reputationally with everybody we work with, and not get so dialed into this one little transaction? Now, if this was all you owned and after you sold it, that was kind of it, okay, I can get tussling with it a little more. But you did 30 something deals last year. You'll probably do 30 something this year and 30 something the next year. And, I'll tell you this, the other good thing is if the market does take a dip, your track record is really going to matter. And selling today might be some of that confidence people need, when you're trying to raise money at the bottom of the market, which is a lot different than raising money at the top. So it's all these little pieces, but I would think on the big scheme of things, selling, a few assets might have a lot more intangible upside than just the dollars that you're going to take out of it. And that's certainly been my experience, and a lot of the experience of the people I've listened to along the way.
Beautiful. Thanks, Chris. I didn't know this was going to turn into a personal mentoring session. So
it's a great conversation. It's a great topic to sell or not to sell. And there is no right answer.
You pick the next topic. We have a list over here.
Okay. Let's talk about the GP structuring and maybe fees. And you got ripped apart the other day on Twitter for some. I actually didn't even read it that day. I'll tell you what. You want me to tell you what happened, and then you can imagine that.
I'll tell you what happened, and then you can add your 2 cents. There's another Twitter GP that is kind of half friends with my, an acquaintance, but becoming a friend of mine. Great guy, great operator, has a great track record of converting the the old Kmart's and the old stores. He built them out and converted them early on, sold some deals, made a ton of money for his investors. Now he owns about a 1.5 million square feet, so a little bit bigger than me. And one of his deals got out. Somebody screenshotted one of his private deal docs, put it on Twitter, and he had a 4% acquisition fee, another 2% sourcing fee. What ended up being deal level fees, about 7 or 8% of the purchase price. They also misrepresented his promote and thought he had a 70% promote when he actually only had a 30% promote because they read the deal docs wrong. But anyway, this guy started getting totally poo-pooed all over retweet. Many people on real estate Twitter who had no knowledge of his deals, no knowledge of the nuance, no knowledge of what was happening, started saying, this is criminal. I can't believe this is happening. It just made me sad. Like, I didn't really have an opinion, but just to see GPs who light up another GP, it wasn't even LPs or capital providers like saying, oh, this isn't fair, I would never do this deal. It was like a group of GPs virtue signaling to the world that they would never charge those fees and that it was criminal and that it was so sad that this GP was ripping people off and giving them a bad name. I don't understand that. I mean, first of all, it's a world of abundance. The more people that are raising money and doing deals, the better. You don't agree with somebody's deal docs. First of all, if you've seen a screenshot of a 30-page deal doc, how the heck do you have any right to poo-poo on anything? Because you don't know anything about the deal. And yeah, it was just kind of sad to see this guy get totally lit up in public by a bunch of GPs who should be rowing the boat the same way. I mean, look, somebody else has the guts to charge a 60% promote. I'm gonna clap for them because that's amazing, and they're moving the market even further in my direction. It seems to be good for me, right? When people raise their prices, I just don't get it.
So I don't know the deal, but I wrote down some notes while you were talking. So there's kind of two things I think about here that don't often get discussed. The first is when you're raising one, I think it's sick that people get deals and then take screenshots and blast people on the internet in front of everybody. It's like people that go to Yelp to cry about a bad restaurant experience when, some people are doing their best. And I'm not condoning whether the structure was good or not. I don't like when people do that. But here's the thing. It's so interesting to me. Some of the biggest fraud and manipulation in the entire financial system happens in the public markets. But it's so all these compensation committees on how executives get paid and all these triggered bonuses but the problem is it's so hard to understand that the common guy will just go buy any stock. In those situations, they're getting so ripped off and they don't even know it. But it's hard to point the finger at like who's to blame. And, there's all these things when in reality, in a private deal, it's a lot easier to scrutinize what's going on. And so to everybody that sees a deal structure in the private world that looks off, what I would tell you is there's all these brokers and wealth managers and all these things, and they're not knowingly doing anything wrong. I don't think anybody has bad intentions, are putting people into these stocks and these public companies that I would argue in a lot of them have such messed up compensation methods that benefit heads I win, tails you lose situation.
Yeah, look how crazy the SPAC. Yeah, all these SPACs that Chamath and those guys sent out to the public that have they're down 80% plus, and he already got rich. I mean,
correct. Yeah. And then the second thing I would say is most of the time, and this is kind of two things happening in the world. And I think it's so early that it's hard to make a judgment right now. But forever, before this democratization of capital was happening online, where people had access, not just to real estate, but you can go buy a piece of the Mona Lisa now, like a fraction of it on some website. I mean, every asset now is being open to the world. And so there's trillions of dollars, trillions and trillions and trillions of dollars rushing their way into assets that has never been there before. Supply and demand fundamentals. So what used to feel like this is the way you structure a deal and this is what's fair or what's market is changing as supply demand comes in. Most of the people that go online and complain about deal structures have shitloads of deal flow. They see tons of deals. So they're able to very much understand, well, this looks off from something I've looked at. Where I'm saying it's early, and again, this isn't me condoning a GP taking advantage of an LP or not. It's me just saying, here's how I see the world. Now let's think a little deeper before we go call a spade a spade. Folks, not everybody has access to deal flow. And so if your answer is, do I take a worse off deal structure and maybe into a good deal that's just favoring the GP, or do nothing at all? That's what a lot of people are faced with doing. And what I would tell the people that may be getting into some deal structures that I guess by some people could be looked at as less favorable, at least they're getting in the game. And again, if it's a bad operator with a shitty deal and a scammy guy, that I'm not talking about that. I'm talking about a great operator that might have more leveled up terms than somebody else. But at least getting in the game and getting in your first deal and learning will make you sharper as you hopefully do deals 2 through 10. But to sit here and say that somebody's so wrong for a deal structure when the demand for real estate, private capital trying to get into real estate is at an all-time high, usually is coming from someone that's fortunate enough to see hundreds of deals a year. And they need to put themselves in the shoes of somebody that might see 5 deals a year. Again, that's all a disclaimer of, I'm not talking about like if it's some terrible GP that scams a bunch of people. That's totally different than anything. We're talking about supply demand fundamentals. And what I would tell anybody is, a downturn will correct some things. Structures will tighten up again. But over the next 20 years, if all these people can now participate, whatever deal structure was popular in the 90s and early 2000s might not ever come back. There's a lot more market participants now. So we'll see. It'll be interesting.
Yeah. And I knew the details of this deal that my self-storage friend released. I knew what happened. Nobody else did. Nobody who was screenshotting and pasting what happened online knew what happened. I mean, he was about to buy a deal for $5 million less than what the property was worth. And he went to his LPs and said, hey, would you rather me charge a 50% promote like I want, or an 8% acquisition fee? I need one of those things. And they said, no, take the 8% acquisition fee and then get the 30% promote and let us in the damn deal for the upside. And that's what he did. Somebody got his deck, screenshotted it, put it online. He got lit up. And I'm telling you, this guy's a legend in our business. He's a very reputable self-storage operator. So it was just sad to see. This is the hive mentality, right? It's the hive mentality of Twitter and the war between capital and the people who need and want capital. And the fact that right now, yes, capital is a bit of a commodity. Operators and GPs are in really tight supply. Okay, you think that's unfair? My advice would be go be a GP. Do the hard freaking work. Somebody asked, like, what are the 3 hardest things that I do on a day-to-day basis? Those 3 things are all to do with operations. Being a GP is freaking hard. You got to find the properties. You got to negotiate the properties. You got to go see the owners. You got to pick up the damn phone and have these uncomfortable phone calls. Then you got to buy it. Then you got to fix the whole building. Then you got to raise rents on a bunch of tenants. All this stuff is really, really hard and not fun. Everybody wants to invest capital. Everybody wants to sit back and criticize. Not enough people are in the arena doing this, obviously.
I would just say at the end of the day, as long as that GP wasn't holding a gun to any of those LPs' heads to invest with them, it's a free market. Do what you want to do. Mm-hmm. And I feel sorry for whoever that was that got ripped apart. And the next 20 years, a verdict will be out. I think the tailwinds, because of the amount of LPs trying to get into the space, favor the GP right now. Whatever that means to somebody, just look at supply demand and you can make your own judgments from there. But in no other time in history, because of what the internet has done to give people access to assets.
CrowdStreet, Fundrise, Twitter. And just to put some perspective around this, for the people listening. 10 years ago, you wanted capital. 10 years ago, you wanted capital. You went to the family offices and the family offices told you how high to jump to get their capital. Hey, you want my money? This is how high you got to jump. And this is what you got to do. And oh, by the way, I'm going to own almost everything. Now it's a little bit different because everybody and their brother who has high net worth has access to people through the internet that are doing deals. So they can see more, they can do more, they can invest more, they can diversify more. And frankly, not enough Americans have real estate exposure. We talk to people every single day who want and need real estate exposure, and they don't have it. They can't find it. They don't know how to get it. So, I mean, if I had to guess, just wild guess, I think more and more and more people are going to continue to syndicate deals. More GPs will merge. and more LP opportunities, and more people will become LPs.
Yep.
And we're going to stop right there. I'll release the second half of this conversation with Chris Powers next Monday on the Nick Huber Show. Thank you for listening. Juniper Square, the sponsor of our show, recently did a capital raising survey. And in this survey, they asked 142 senior executives at U.S.-based commercial real estate firms a series of questions to understand the state of commercial real estate fundraising. It's an insanely valuable report with data on questions like, how much capital did you raise last year? How long did your last raise take? What type of investors are you raising the most from? And what strategies are working the best for you to find new investors? Download this report for free at junipersquareresearch.com. That's junipersquareresearch.com. Big thank you to Juniper Square for sponsoring the show. Thank you for listening to the Nick Huber Show. Just wanted to remind you that we have a paid real estate community where some really special stuff is happening. People are breaking down deals. People are networking. People are, I think, even formulating partnerships inside this group. We have over 100 members now. For more information, you can visit sweatystartup.com/REC. And the first 299 members of the group to get some momentum get $200 off the annual membership using the code FIRST299, FIRST 299. And also, you can check it out for 5 days for $1. You make a $1 payment, you can check out the community for 5 days. Highly recommend it if you're serious about bringing in some other people into your network, into your life, to help you become a better real estate investor.